todos los aquellos que se conectan desde Europa.
Hello, good afternoon to those of you in Europe, good morning to those of you in the Atlantic. It is a pleasure to welcome you to a new Wealth Talks, an exclusive series of talks for our customers. The purpose of these talks is to make available to you the opinions of experts in different areas which have an impact on the economy and on different markets and on different investment strategies. The talk today will be in Spanish. If you want to listen to it in English, you just have to press the interpretation button on the side of the screen. And if you want to ask questions for our speakers, we encourage you to do so through the questions button on the app. When it seemed that we were leaving the pandemic behind thanks to the vaccines, the Ukraine war has really shaken us, and the world is really shocked that something like this can happen in the 21st century, and the event has had a huge impact on the social, political, and economic areas. And of course, this is a topic that deserved a wealth talk. Obviously, we don't have a crystal ball, so we're not going to be able to tell you what the future is going to look like, but we can make a detailed analysis of the past and of the present to understand the possible scenarios we may encounter. And to do this, I have two experts from the Santander Group. The first one is Juan de Dios Sánchez-Roselly, responsible for strategy for Santander Private Banking. Hello, Juan de, how are you? And I also have Mazoy, who's Global Investment Manager of Santander Asset Management. Welcome, Jose. Thank you, both of you, for joining me today. What we have done to prepare for this event was to compile a series of questions that our bankers were getting and those that you were asking more frequently, and we've organized the questions into 6 sections. And the first of these sections is the geopolitical one. One day, this conflict in the Ukraine has significantly altered the world geopolitical order. So, confronted with an event like this, what can we learn from similar events of the past, and what variables need to be considered? Thank you, Christina. Well, in the case of geopolitical risks and military conflicts, unfortunately, there's a lot to look at in history. Here there is a chart that measures the number of victims of war. This graph encompasses from the Second World War. Then what I can say about this graph is that unfortunately wars are a constant in today's world, and we haven't had any period when there was no war in the world. But then there is a positive comment I want to make, because since the Second World War there's been a downward trend in the number of military conflicts, and this has been very good news in the last 80 years. After World War II, we had a period where Europe learned from the sad lesson of the Second World War and the First World War, and different political organizations were created, like the European Union, which made it possible to promote understanding across European countries. But then there was the Cold War between the US and the USSR, which resulted in different conflicts in different parts of the world, such as Vietnam and Korea. Then there was a very important event, which was the collapse of the USSR and the collapse of the Berlin Wall, which brought in a period of peace and a reduction in the number of geopolitical conflicts, and a golden era of globalization, where the entrance of China into the WTO was very important. And it seemed that the world had learned a lot to do things more peacefully. But now we are confronted with this invasion of Russia into the Ukraine, and we wonder what the repercussions may be. And many analysts are saying that there's going to be very important changes. We are faced with a world where geopolitical balances have experienced many changes, and there are also going to be many changes in the economy. It's not just a military and geopolitical event we're talking about, because the reaction of the West has been very compelling with an economic war launched on Russia, because these measures resulted in the isolation of Russia in the financial, commercial, and economic domains. This other graph shows you an index which was drafted by two researchers trying to reflect the level of geopolitical tension in the world through the automated searches of certain newspapers. So this index was put together, and what we can see is that the invasion of the Ukraine has had a level of seriousness that is only comparable to the attacks of 7/11 or the war of Iraq. So the level of geopolitical tension cannot be directly correlated with the number of deaths. The level of geopolitical tension in some cases is low, but the number of deaths may be high. But this event, in today's talk, we're going to be focusing about the importance of this event and the influence of this event on the markets. And we have analyzed the most important 12 events, the 12 most important events we have lived through since World War II. And we've tried to see what the reaction of financial markets has been. And there have been two types of impacts. Measured by the reactions of the American stock market. The average of this event led to very significant falls in the stock market. But if you analyze the 12 months after these events, we see something very surprising, because markets rallied very quickly in that 12-month period. But this is an average, of course. If we analyze each of these events individually, we will see that there are differences between some events and others. And the reasons for these differences, we have analyzed them from two standpoints. First of all, the perspective of the severity of the geopolitical conflict itself. And here we have introduced three levels of conflictivity. 3 Gs for the most severe events, and then 1G for less severe events, at least less severe at an international level, such as the missile conflict in Cuba. And then we analyzed the importance of these events at an economic level with the repercussions they had. And the ones in gray were the events that had the greatest economic importance, because they resulted in a fall in the GDP of the American economy of 5%, following the Suez Canal crisis, 6% in the oil embargoes in the 70s, and then 6% after the 11th of September attack. So how can we interpret this information? Well, if we look at markets in the medium term, well, if you look in the medium term, well, markets are only concerned if there is an economic implication. And in this talk, we're going to be analyzing this geopolitical conflict and how it is infecting the economy. And the first indicator we want to show you is this financial conditions index, which shows the nervousness in variable income markets. And you can see that current levels, well, everybody was very optimistic, everybody was very positive. This crisis has had a negative influence, and well, the current levels are not really too bad, much better in any case than in previous crises where levels of -2, -3, or -4 were hit. So the first conclusion is that, and if we tried to analyze the level of economic risk, which is very important for markets, so the first thing we can say about this variable is that the financial risk as perceived by markets is slight. We will be watching this metric, of course, and we will be analyzing other areas where we might observe significant economic consequences. Right, what is undeniable is that the impact on the prices of oil and of energy and of food of this conflict is being huge, to the extent that the inflation has reached very high levels. So the question would be, first of all, why is this happening? Or to put it differently, what is the role of Russia and the Ukraine in the global economy? What is their weight in the global economy? And if we focus on energy, I wanted to ask whether there may be a lack of supply of energy in Europe, whether there may be shortages in Europe. Well, touching on the point that my colleague was mentioning about this economic war, what we wanted to do was to understand what this effect would be on the Russian economy, which clearly is going to have a greater effect than the effect we saw in 1998. There's been a huge depreciation of the ruble of more than 60%, which is going to result in a recession in Russia. And I think it is important to place this recession into a context, into a global context. And so the first thing we did was to try and understand from the economic point of view and from the point of view of the markets what the importance is of Russia and the Ukraine in that respect. And what we can see in this graph is that at the level of proportion of GDP, Russia accounts for 3% of the global GDP and the Ukraine 2%. In terms of financial markets, the situation is similar. If you look at the market cap of these markets, looking at global indices in emerging markets, you will see that the proportions are really very low. So in that respect, what we can see is that the importance of Russia and the Ukraine in economic terms and in market terms is really quite limited. Here, I would like to also mention the exports of the different countries in the world. In Russia, how much is exported into Russia? And we see that the figures are very low. In the case of Germany, exports from Germany to Russia account for about 0.8%. So the impact of the conflict, on global exports is also going to be limited. So that is, what we can conclude from this. But what is also important is the role of Russia and the Ukraine in terms of raw materials, because they are two countries which are very important producers of raw materials for agriculture, metals, and oil and gas. And we will look at this in a minute. The first slide shows that both at the level of production and exports, in terms of wheat, for example, the levels are very high. The levels of Russian and Ukrainian exports are very high. And as a result of the conflict that we are witnessing, there have been very significant spikes in the prices of these raw materials. For example, you see that the price of wheat this year has risen at a pace of about 50%. Now, in terms of metals, what we see is a very similar situation. For example, in terms of palladium, you see that Russia is the main world producer of palladium. It accounts for 43% of world production. And palladium is a raw material that is used to produce vehicles, and you can see that basically the price of these metals has risen significantly this year, and this will have effects, as we will see in a minute, on inflation. Lastly, I would like to mention the effect on energy, which is probably the most concerning factor. And we can see that at a production and export level, Russia also plays a very important role in production of oil and especially natural gas, especially in terms of its exports to Europe. Natural gas and oil have experienced very significant spikes in, this year, first of all because of the recovery from COVID, but also the armed conflict has exacerbated these spikes. And what we see is also a huge volatility in terms of natural gas. Today, for example, there was a rise of 40%, in the United States 22%, but these rises reached up to 100% on some days. Christina, what you were saying about the dependence on Russia and on the Ukraine in terms of energy and potential shortages, here you see the dependence of different countries on gas, coal, and oil imports from Russia. And this is quite an eloquent and concerning graph. Germany, for example, depends on Russia for 1/3 of its energy needs. In the case of Germany, as I was saying, Russian gas accounts for 60% of its gas imports. I also wanted to analyze how much oil is produced by Russia every day. They produce 7,000 barrels. And what is going to happen as a result of this conflict? Well, there are countries that import oil, particularly 2.5 million barrels a day are imported by China and India, and we believe that there's going to be no problem with these imports. The oil is still going to flow into India and China. But what about countries that have imposed restrictions against Russian oil? So we wanted to try and understand how this oil shortfall can be addressed. It's a shortfall of around 4.5 million barrels. One possibility is for China to stop buying from OPEP and start buying more Russian oil, and in this would mean that the OPEP will be able to export more oil to other countries. Another way of doing it is for the United States to start producing more oil, provided that restrictions are lifted against production using shale, both in terms of gas and oil. Another way of doing it is for some of the agreements with Iran and Venezuela to be reactivated, and the sanctions imposed on those countries might be lifted, and this might generate greater supply of hydrocarbons at a global level. And finally, countries in the Gulf, particularly Saudi Arabia, might start producing more oil. These are some of the ways in which the shortfall created by the restrictions on Russia, these are some of the ways in which those problems may be solved. This is the evolution of oil and natural gas prices. There's been a huge spike, not only as a result of recovery from COVID, but also now as a result of the crisis. There have been very strong rises both in the prices of gas and oil. And I would like to refer to the framework mentioned by Juan at the beginning, namely, what is the impact in terms of, is it 1E, 2Es, or 3Es? Well, today the price of natural gas and oil have fallen a little, but the levels are still very high, and we really don't know what the evolution will be in the near future. We don't know what the evolution of the geopolitical conflict is going to be, so we need to be very attentive and be on our toes. And we, would assign a double E in terms of the economic risk that exists. Lastly, I would like to mention what would be the effect, the foreseeable effect, the effect foreseen by the ECB in terms of growth and inflation. At December 2021, the growth estimation was around 4.2%, but the European Central Bank corrected to 3.7%, so 0.5% less growth. And in terms of inflation, the forecast is that inflation in 2022 is going to be higher. It will go from 3.2 to 5.1. So there's this discussion as to whether we're going to fall into stagflation. If we believe the European Central Bank there's going to be higher inflation and less growth, but growth will still would still stand above average European growth levels, so we couldn't really say that there might be stagflation. So growth would be higher than inflation. Right, yes. Now, what about the financial system? What is the health status of the financial system in Europe today, especially as compared with the health bill of the European of the financial system in previous crises? Well, the financial system is very sensitive to crisis because the role of banks as channels for loans, is undeniable. In this graph, you can see the evolution of the trading of some of the European banks. We analyze different dates there. Generally speaking, there has been a moderate fall at the level of the industry. The sector, had fallen, the values had fallen, but banks such as Santander are at high levels, and at the beginning of the year they still haven't gone back to the share prices of before the crisis. But some banks such as Santander, which we're not really exposed to Europe, but on the contrary we are exposed to Latin America, which is a continent that has a lot of raw materials. So our bank is managing to weather the storm quite well. But other banks such as ING, Societe Generale, etc., investors are more concerned about those banks, and this is because these banks are directly exposed to the Russian market. These four banks that have fallen, whose share price has fallen most sharply, have a lot of business in Russia, and they're quite significantly exposed to the Russian market. But we need to measure the level of risks of these banks to see whether we have a systemic problem in the European financial system, which might accelerate economic concerns. We need to measure this risk in terms of the capitalization of these banks. The market cap, the capital of banks is a kind of airbag that makes it possible to absorb these economic shocks. And the capital ratio measures every 100 risk units how many capital units you have in order to absorb negative events. The financial crisis was very dire for the financial system because the capital levels were low, around 6%. But as a result of the regulation by the European Central Bank, we're now at levels which are twice as high as those before the economic crisis. Now we stand at levels of around 14%. Unicredito, for example, a default in Russia may, have an impact of 2 percentage points in the capital ratios, but now the capital ratio is now 15%, so it's not really a very big problem for them. So the financial system in Europe is very strong. The capital situation is very strong, and so it is so strong that it can absorb this risk of default of Russia or the problems in Russia. And the metric we use to analyze the degree of nervousness of the market with respect to the financial system is a metric called the spread of credit default swaps, which measures the cost that an investor in bonds may have to pay in order to hedge against these risks. And the current level compares favorably to the levels of 2012 and 2013. So if we had to grade the risk in the European financial system, we believe that the risk is really very low. We would assign just a single E to this risk. So we're better prepared today than we were during the financial crisis to face up to a crisis of this nature. Yes, much better prepared than when Russia defaulted in 1998, where many hedge funds went into receivership. All the different European funds and all the different banks have assumed that Russian assets are worth zero, and really, so far we haven't seen any investment fund go bust. We have talked about stagflation, and this was something that started rearing up its head at the end of 2021. It's a kind of trending topic for us. Inflation is really at a very high level. So, Jose, what do you think about this? Do you think that inflation, these high inflation rates, are temporary, or are we on the verge of a cycle change? Well, we should look at the evolution of inflation in the last few years, particularly this year. Basically, the inflation levels we're witnessing across the world, particularly in the US, in Europe and in Spain particularly, are very high. For example, the graph you see on the slide on the evolution of inflation in the US, you see that there hasn't been an inflation rate of this nature since the 80s. And here what we see is overall inflation and underlying inflation, or the core inflation. The difference between these two is the effect of energy prices and food prices. So you can see that there is a significant effect on energy prices and food prices, but even so, the core inflation is still very high. This core inflation, we have analyzed it very thoroughly, and it is basically due to disruptions that exist in the production process, in the supply of products, more products and services actually. It is not so closely related with the economic growth seen in the US. Even if there is a positive output gap in the US, it is not really related to it. And here there is an interesting graph. This type of inflation that we are witnessing currently basically is not really related with the unit labor cost, and this is a variable that concerns many people. The effect, the second round effect, which is what starts perpetuating inflation in the system, for inflationary expectations to change. This is what really concerns people. So inflation is at high levels. It is influenced by these disruptions at a production level, and as these disruptions are resolved in the production process, then the inflation rate is also going to go down. If you look at the case of Europe, the situation is even clearer. Here there's a higher difference between total inflation and core inflation, and on the right you can see that a significant part of this difference comes from the price of energy, which in Europe specifically is influenced by the price of gas in Europe, which has risen much more than the price of natural gas in the US. So as this conflict resolves and as alternative sources of energy are found, then all of this is going to go down. Our view is that this is a temporary thing. In the case of Spain, there's a runaway inflation, but it's the same thing we are seeing in the US and Europe. It's just a temporary thing, and this is also what the market thinks. This graph is interesting because it shows you 5 years within 5 years forward, which is a very good indicator of the market expectations. And you see the situation both for the US and for Europe. And you see that today's levels are quite contained, around 2%. This means that basically economic agents and the market think that eventually the inflation is going to recede, and basically it is going to be a transient thing. For that reason, going back to what we were saying at the beginning, I would say that in the short term, we would give this risk a triple E because it is something we need to watch, because there is going to be high inflation rates for quite some time. But we think that in the medium and long term, this treble E would go down to a single E because it's a transient effect. And there's not going to be a second round problem that may affect people's expectations.
When we talk about inflation, we were saying that one of the reasons behind inflation is a continuous growth of the price of energy, and I think that this bears a close relation with the conflict and how Russia is a huge gas and oil exporter, at least with Europe. I want to ask you, Juan, how do you think that this is going to affect the prices of inflation, are going to affect our energy transition, and do you think this is going to hinder them, or it's not going to have an effect and they're going to go on? I'm going to answer about the energy transition from a broader point of view and how Europe is replying and facing this very interesting challenge with the Ukrainian situation. When we talk about energy policy, but we also must discuss the possibility of offering positions that can mitigate economic slowing down the economy. So I was wondering, it's interesting how markets were surprised by Europe's unified response to this event. Here in this graph we can see how each country has had a different response, and with the imposition of sanctions, delivery of weapons, or how they have answered. And Europe responded en masse as a bloc because Europe could not really respond to this new energy and geopolitical framework, but if we work together, we can give an answer. So, when it comes to the political answer, Europe has given as one, and when we talk about energy policy, it took us a few days to launch a very ambitious program, which is called Repower EU. And they're not only looking for energy flexible solutions such as gas, looking at diversifying gas suppliers and liquid gas, but bolstering the development of renewable power sources, which would allow Europe to be energetically independent, and this will lead us to creating green sources such as green hydrogen. All crises offer new opportunities, and the one we're seeing in this situation, one of the ones we're seeing, is taking advantage of the energy transition and taking advantage of the situation. A less positive outlook to this is, well, higher expenses in defense, which is not what people like most. Europe doesn't usually like spending more on defense and following in the US's trail, but this conflict has awoken us to a new reality, and the huge surprise was that, well, the Germany has decided to double their defense expenses by 100 billion, and they've been approved with a green government in which they have a coalition in which the Green Party is very, very present. It's very shocking that they were able to undertake these measures and that they've polled positively. So, as far energy policies, we are bolstering public expenses in this case, and as for renewables, well, something that's very important, which is the risk of disunion. We take a look at external risk, and it's how we finance countries that have worse economic situation than Germany, that have more trouble self-financing, such as Europe and Italy. When we've had these sorts of crises, and in Europe and Spain and Italy and Spain, we had problems because we felt that the European Union was at risk. Financing, Italian and Spanish bonds financing have had a little spike, but it's nothing similar to what we've seen in the past. And well, we think that this has to do with this positive reading, which is the union between European countries when it comes to facing such hard situations. Yeah. Together we are strong, right? Exactly. Jose, we had a collection of questions asked by our customers, and we're entering into the last block, and we're talking about monetary policy, and I would like to discuss what we can expect from central banks and what markets are seeing when it comes to these central banks. Well, as far as monetary policy is concerned, I think it's impossible not to take a look over our shoulder and look for similar situations in the gas market. So we can go back to 1973 and the 70s, 1979 with the Iran Revolution, which had an impact on the cost of oil, and well, it led to inflation rates, and well, the Paul Walker had an impact as well. And I think that this as well, this means that a lot of investors can ask questions. So we are reaching a situation in which interest rates grow a lot. And well, given this, we had a very interesting exercise, which is what we have here, this graph. What we see here is our energy dependence as of today compared to the 70s. And basically, the easiest way to understand this is that to produce one GDP unit, in the past we needed about 300 barrels of oil. As of today, we only need 100 barrels of crude to create one GDP unit. This is a very easy exercise and showcases that our energy dependence has been reduced by almost 70% when compared to our GDP. So we rely much less now on crude oil to produce things. On the other hand, what we see here is the evolution of oil prices, and we can understand if this spike can be compared to what we saw in the 70s, bearing in mind our reliance, our dependence on oil. The red line is the price in dollars. In the 70s, we can see that this was $36. Of course, this is, well, we can't compare it to today's price, given the inflation in the last 40 to 50 years. Of course, if we compare it to today's prices, inflationary price would be more akin to 117, and if we were to multiply it by this, if we were to triple it, as I mentioned earlier, the actual price would be 315. So we can clearly see that the price we're seeing today, 125 as of today, is closer to 100, so it's closer to the prices we had seen in the previous oil crisis. What we see in this next graph is basically the evolution of our interest rates, the Fed's interest rates, and the underlying inflation index. And as I mentioned in our previous section, is underlying inflation, fortunately, is not getting a second round effect, is not catching unit labor, is not having an impact on underlying inflation, and it's, well, all the disruptions we're seeing, it's more related to the disruptions we're seeing in the production process. So while it is true that there seems to be a correlation between short-rate interest rates and inflation, the Fed doesn't think that there's going to be a huge spike, and this is really what the market is taking into account. And what we see in the market here is the evolution of the futures of short-term rates. And in the States, the market believes that the short-term rate will reach 175 by December 2022, which means that there will be 6 hikes in short-term interest rates in the United States. We can see that when the conflict started, the market started to discount that there would be less hikes than what we are expecting today, but it quickly came back to pre-conflict expectations, and as of today, we are expecting 6 hikes throughout the year. In Europe's case, we can see the depot rate, which as of today is at minus 50 basis points. By the end of the year, it will reach 0, which means there will be 2 hikes by the end of the year. So what we're seeing is that the market is... We are still seeing hikes, but not uncontrolled hikes, not spikes like the ones we saw in the 70s. We can double check this when we take a look at the interest rates in the longer term. If we take a look at the US and Germany's government, that's what we're using as a baseline, which are in 2.2 in the States and 40 basis points when it comes to Germany. These levels don't reflect that the market is expecting that inflation is going to have a long-term effect. And something that's really encouraging, the rate curve is not inverted. As we all know, whenever this curve is inverted, well, that's a very good signifier for a recession coming. But we're not seeing it in long term. So when we go back to the framework we had discussed when we started talking with Juan, we are only giving this one E when we think about fixed income, the fixed income market, both at the short and long-term markets, and hikes given the increases in oil prices and the effect it can have on inflation. Great, thank you very much. We've got over 1,500 customers logged on today globally because we wanted to give them some time to ask some questions, and I'm just going to ask them machine gun style, and you just reply. So I'll start with one. I'm going to combine 2 of them. They're asking here, what can we learn when it comes to investing from this crisis, and what investing opportunities are opening up for us? I'll answer as far as private bank is concerned. I think that the most relevant answer we can get out of this is, when it comes to concentrating, we need diversified portfolios. If we take a look at the fragility of Europe's situation, well, it comes from our energy dependence on a single market. And this, when it comes to investing, well, this could mean having one asset, one single instrument. So whenever one single aspect affects this investment, it can wreck your portfolio. So, well, that's the problem we're seeing. Well, it comes from the fact in Europe that low probability situations, but scenarios that can happen. So the most important lesson is to have portfolios that avoid concentration risks, really well diversified portfolios, different countries, different fields, and make sure they are properly balanced. That is to say, having hedging strategies and having a lot of assets that will react positively that can react positively to different shocks, assets that mitigate risk. In this situation, well, we talk about precious metals, precious ores, strong coins like the dollar, of course, and, well, having assets that shield you from negative effects, and more importantly, well, something we have to bear in mind for this crisis, the most relevant shock we're finding here is inflationary impact in the short term. We need investment portfolios that will behave properly in an inflation situation. We're not foreseeing a higher inflation in the long-term future, but we need portfolios that will have assets that don't suffer in high short-term inflation and moderate long-term inflation. Those are the three lessons we are trying to, well, impart upon our customers. Any opportunities you'd like to underscore, Jose? Well, I think that Juan explained this wonderfully. First and foremost, I would say that it's very difficult to estimate the impact of a geopolitical crisis. Making long-term choices is very difficult, so we think that it's very important to make long-term choices, and like Juan said, we need diversified portfolios. We need diverse portfolios that can benefit from all sorts of risks, that can take advantage of their diversity. Overall, we like diverse portfolios. Whenever there's a geopolitical risk, we obviously want to be in a better situation. But what we need to see is we have to take a look at long-term variables, and I think that long-term variables, both as interest rates are concerned and in the short and long term, are not unfavorable. But obviously, in this situation, and we need defensive assets, they're also asking us if these monetary policies can be good when offer is much more relevant. Well, we have a very important event today as far as monetary policy is concerned. The Fed is going to say now at 7 Spanish time, they're going to voice their opinion on hiking rates in the short term, but it's going to offer us some guidance on, well, how variables in the medium term are going to affect us. So what I think that is very important when we take a look at what we've seen these last couple of years, the increasingly important role central banks are playing, how they've improved their monetary policies. And I think that this is one of the lessons we've learned when it comes to monetary policy evolving and how they've used liquidity tools to offer us some guidance and offer liquidity and calm us down. I think that Jose explained this very well. We've got a short-term inflation situation, which is very important. We have to bear this in mind. But the calm we're seeing in monetary curves is really, really important. No, I think that, well, we could see in the graphs that we were showcasing a few minutes ago that inflation, underlying inflation, is given much more, given the disruptions we are seeing in the production of goods. And I think that the Fed is going to act consequently, and I think that it's a transitory effect, because monetary policy, when it comes from the offering side, when it comes to controlling this inflation, given that we are going to overcome certain aspects. Having said this, the challenge central banks have ahead is huge, because this is an inflationary shock that comes after another inflationary shock, and they are coming from different fields. Like, this isn't the energy field, but the food aspect, and all the logistical problems that are going to come from these sanctions that are going to obviously have an impact on where we are buying, how goods are transported, and how commodities are transported. And I'm going to mention an actor, a very important actor that hasn't been mentioned earlier, China. I'm going to mix two questions. How is volatility related to their markets? And the other one, that there's a relation. Who is going to win in this? Who is going to win in this conflict? Of course, I'm mentioning this. If China can get anything out of the situation, I'll answer the last part. It's very complex, and these last couple of weeks have seen everything change several times, and the effects that these are going to have, the sanctions. China, Jose explained very well that they are much more flexible, and it's not going to suffer the negative impact of the commodities price, and they can actually buy the oil Europe isn't getting. They can just buy it in bulk from Russia, so they have a positive effect in that respect. As far as sanctions are concerned, well, the technological and financial reliance Russia is going to have on China, well, it's going to be good for China, of course, because Russia will not be able to get into the technological and financial market. So, of course, China is going to become more relevant. But at the same time, there are other worrisome aspects. And as of today, China is being very careful when it comes to how they are backing Russia in a very commensurate way. They are being very careful, and they are being careful on the geopolitical consequences of this situation. So they're being very careful. And yeah, well, I think that it's very similar. The graphs we took a look at earlier. If China stops buying OPEC oil and starts buying more Russian oil wholesale, this is going to offer them a huge advantage, and Chinese volatility is also going to come from regulatory changes we are seeing, and this, of course, means that, well, there's going to be uncertainty in all markets, and I think that this energy crisis, given their position when it comes to Russia and their position, this could actually benefit them. Very good. I'm going to go on with China because a lot of people are asking about China. This is the last Chinese question, and there are many more questions. So they are asking here if we should hold our positions in China or if they should reduce Chinese exposure. I don't know if you have a clear thought on this. Well, when it comes to actual asset advice, we have to take a look given each customer's risk profile. China, within equity, is one of the most volatile markets. It's not a very mature market when it comes to regulation, and something that worries a lot of people is what we've seen in Chinese actions. They've got derivatives when it comes to Chinese unlistings that were listed in the U.S. There are, of course, idiosyncratic aspects when it comes to Hong Kong. And, well, there are additional risks beyond equity investing in Europe or the U.S., for example. So I would advise people to be cautious in the short term. There are aspects which are affecting the Chinese market, which we should clear up. First, this new wave of infections. China had a zero tolerance, and they were imposing restrictions that has worked up until now, but it would appear that it isn't working anymore. And vaccination levels and vaccination efficiency, Chinese efficiency, is not as good as other countries, and that's very important. And what Jose said when it came to regulatory aspects, because at the end of the day, Chinese policy has changed. These have changed given prosperity, and, well, it has had negative impact on certain aspects, and well, we should be cautious, and we have to see how this is going to affect all of our customers. Anything to add, Jose? No, I think that he was wonderfully clear. They're also asking if Latin America should see this as an opportunity. Well, Jose, you were talking with Santander Asset Management Brazil, so Brazil has been our shocker this year. Well, Brazil, of course, has had, given the situation and the turbulence in international markets, we've seen a lot of flows, capital flows towards Brazil, which means that Brazil has worked very well this year, and it's one of the very few stock markets that has performed positively throughout the year. So I think that Latin American countries obviously export oil overall, and this can have, well, when it comes to hydrocarbon prices, well, it has an impact, and it can have an impact on all countries that export these commodities. And of course, we have complex matters as far as politics are concerned in Latin America, so we also have to be careful with this. And well, this is the last question because we're running out of time. I think that both of you mentioned this, but since a lot of people are asking about, is this, are we slowing down, or is this a recession? Jose, you said that we are growing more slowly. If you want to go on. Yeah, no, well, what we're seeing today is a very dynamic situation. We want to explain the variables. We monitor every day to see how the economy is slowing down. There's going to be an economic breakage, and what Jose explained, we had very good growth levels. So the impact, of course, it's not the same thing to have a negative impact when we start from a very favorable position when you're taking off from a very weak position. So as of today, and with the stress levels we're seeing in all fields, in all areas, everything we're focusing on, we are seeing, well, we're not seeing an S for stagflation. We are slowing down. Yeah, no, I think that's our conclusion. Given the analyses we've run, I would say that we are slowing down. We are decelerating. So I think it's difficult to offer a solution on what's going to happen. We've got a core scenario, but there are adverse scenarios. If there's an energy shock, well, of course, the E's change, and how we gauge everything, our central scenario changes. So as of today, that's how we envision what's happening in all markets in the economy. Well, that's wonderful to know, and that is all because we are running out of time. And even though, well, we could talk about this for hours upon hour, but first I want to thank both experts. Thank you very much, Juan. Thank you very much, Jose. This was a wonderful analysis, and I think that our customers have really appreciated this. So, well, first and foremost, thank you very much for taking part and for explaining everything to us. And, well, all of you, thank you very much for logging on. And, well, as usual, all of your wealth talks are online. It's wonderful that you join us, and, well, we expect to see you in our next wealth talk, and we'll see you next time. Thank you very much. Bye.